Good evening and welcome to Money Minutes. My name is Lisa Pallavi Barbara, and today I'm going to tell you about some basic concepts when you venture into stock picking. If you look at the markets themselves, it's been very volatile. One day up, one day down. In fact, stock prices move in either direction very sharply in a matter of just a few days. So what should an investor do? Now, if you look at the broader market indices, you will see the Sensex and Nifty are close to their all-time highs, but not all individual stock prices are close to all-time highs. And what does that mean? Should you buy now? Should you wait for the index levels to come down and then pick a stock? At this juncture, you should take a step back from all these technical features and then concentrate on some fundamental attributes. Now, I'm going to tell you about 4 very important financial ratios which can help you actually figure out some of these fundamental attributes for individual companies. The first one that we are going to talk about is the return on capital employed. Now, this is a very important metric. Experts say that this is as important as, say, an interest rate. So when you give money to a bank, you expect to receive an interest or earn an interest. Likewise, when an entrepreneur gives money to a company, they expect to receive some return from that, and that return is the return on capital employed. It basically tells you whether the capital is being used properly and what profit you make per unit of capital that you invest in a business. It's a very important measure to understand whether the business is being run effectively or not, and a consistent return on capital employed can show that the business is indeed being run properly, and over a number of years it's being run properly. Now, you cannot judge a new company by this kind of metric, by a return on capital employed, because a new company has just got fresh capital, it's still being put into use. You have to look at mature companies when you talk about return on capital employed. Now, the next measure that I'm going to tell you is the profit. Now, that's obviously intuitive. A company is in a business to earn profit, but what you need to check is the profit margin. At the operating level, this is very important. It shows whether the company is able to manage its costs effectively, and what it tells us is what portion of the revenues or the sales actually get converted into a profit. And this is important because you can tell whether the costs are actually getting the better of the revenues, and only a little amount is trickling into the profit figure, or it is a substantial amount. You should also compare this across companies in an industry to understand which company is working better and is able to manage its costs better. Secondly, you need to look at profit growth over a period of time. Now, if profit growth is consistent, then that's a good sign. There could be periods of downturn, but you need to take it in context. If the period of downturn is in a time where economic growth generally is slow, then that's okay, as long as the profit growth is higher for a company, is higher than its competitors. So you need to keep in mind the margin and the profit growth. Another thing you need to keep track of is the gearing. What gearing means is the debt on the balance sheet. Now, debt is a very scary thing, especially in the times today where interest rates are very high. So the cost of debt is actually very high. A company taking on debt is paying interest of around 11-12%, or a small company pays even as much as 14% interest on debt. So the cost of debt is very high. So it's important that the overall level of debt remains low. And secondly, also, in times like today where the GDP growth is slow, sales are not picking up as much. So the money coming in is low, but you have to pay your interest cost, which is pretty high. So the debt has a double whammy. So you should prefer companies which have a low debt, low gearing in today's market, and yet are able to maintain their profit levels in a good manner. Lastly, I'm going to talk to you about something called uncommon profits. Now, in a recent report released by Motilal Oswal Securities, they talked about something called uncommon profits, which is essentially the return you earn over and above your cost of capital. So as long as your return on capital employed is higher than your cost of capital, you are earning an above normal profit, and it's important for a company to consistently earn this above normal profit. And if you find companies doing that, then you've got a good company. So just to recap, focus on the fundamentals. Look at things like return on capital employed, profit growth, profit margin, gearing, and this concept of uncommon profits to make sure that you narrow into good fundamentally good quality companies, then the market levels will not matter and you will be able to buy stocks despite the market being at a high or a low. That's all from me on this edition of Money Minutes. Do keep watching for more investment ideas and updates. Thank you.